Hi guys, welcome to Husslefreewealth. I am with Ravi Handa from Desifire YouTube channel. We are going to continue our discussion on fire. Hopefully you like the last video. In the last video, we discussed about retirement corpus, how much is enough, about the health insurance, then the life expectancy, inflation, etc. So if you have any questions, please drop them in the comments. We'll discuss. Okay. So what is the asset allocation that you have?
Um, Currently, I believe I'm not sure of the exact numbers, but I think I can find it out if you can just give me a minute. Yeah, so this is a slightly dated, मतलब 5-6 महीने पहले का. Yeah, I think it's fairly accurate now क्योंकि वो auto update हो गया होगा. So I currently have 51.4% in equity, 19.9% in debt, 5.9% in gold, and 22.7% in hybrid.
22.7% is what you said. That is in hybrid, right?
Yeah.
So again, that will also be in the equities, right? So if you factor in the equity portion from that, your equity portion goes higher, right?
Yeah.
Around.
So I think that, if you actually split it, let's split it equally because, in this hybrid part, I essentially have a balance advantage fund from ICICI as a huge part of it. I have, equity and another ICICI equity and debt fund. That is a huge part of it. And NPS is another huge part of it. So I believe half is essentially where it will go. Half of it will go towards the debt side. Half of it will go towards the equity side. So if I take those numbers in rough approximation, probably around 63-64% is equity, around 30 odd percent is debt, and around 6% is gold, is how I look at it.
So NPS, you have only half of it in equity.
No, NPS, I have 75% in equity.
Okay, 75.
So somewhere it is 75. In ICICI Balance Advantage Fund, which is the much bigger portion, there is only 40% equity.
Okay, so when you pick up fund,
Overall, I'm saying for calculation purposes, so it might be 63, it might be 65. How much of
yeah,
a
between
difference?
60 to 65. Yeah.
Between
Okay.
60 to 65 is a fair enough estimate for that.
Okay. And do you want to continue with the same asset allocation, or do you have plans to reduce it, increase the equity portion, gold portion, and all of those things?
So as of now, I believe that I'm fairly okay with this sort of a number. The idea is that yes, I would want to move towards a slightly higher, equity allocation as time goes by. The debt part of it, which is currently 30%. So when I'm spending money, I'm spending down the debt part of it and the returns that the debt part generates. And I would, over the long run, let's say over the next 20-year period, I would probably want the debt portion to get smaller and smaller and the equity and the hybrid portion to get bigger and bigger. See, I don't really want to take the call on asset over the very long run. I would not want to take the call on asset allocation on my own predominantly. If I do not
Okay.
spend out the hybrid part, then the asset allocation call is being taken by someone else. I believe that someone else is smarter than me to take a asset allocation call. Let's say if I have a good combination of the NPS part of it, where I am taking some sort of a call, the ICICI Balance Advantage Fund or the ICICI Equity and Debt Funds, let someone else decide that what's the more appropriate amount. And I would like to get away from that. So I'll spending the debt part of it as a bigger overarching arc for the next 10 years, for the next 20 years, till I am, capable of taking these calls. I believe that I should be okay in taking these calls. There, I essentially follow a bucket sort of a strategy that I see that, okay, how much money do I need to spend in the next 3, 4, 2 years? Do I have that much in my debt allocation or not? As long as I have that in my debt allocation, that's fair enough. If I get some sort of an opportunity where I'm able to, you know, possibly believe that the equity markets are doing really, really well, I would sell that and refill my debt part. If it doesn't happen, then the debt part keeps running out. So let's say over the next 4 years, if the equity markets don't do really well, I would have spent most of my debt amount. And then I would probably take a call on, I'll start spending the hybrid part of it or something like that. Because you need
Okay.
to understand that
So
all of the debt that I have, I don't have the option to spend all of that debt because this debt also contains PPF. This debt also contains
okay.
PF. This debt also consists of, the NPS debt portion of it. Oh, sorry, it doesn't contain the NPS, but it contains the PPF and the retirals which are there. And I do have a decent chunk of money in the PPF and PF and EPF part of things.
Okay. So
So
you
the
have not withdrawn your PF as
no,
of now.
I have not.
Okay. And you're planning to do that after 60.
Hopefully never. That is very high rate of tax-free interest that you keep getting for the PPF part. I don't have much in the EPF part. See, the EPF
No, I'm
part is
talking about
very,
EPF,
the EPF is
Employee Provident
insignificant.
Fund.
Huh. EPF is very insignificant. I didn't really have a job for a very, very long period of time. So I don't think I have even 1% of my net worth in EPF. The PPF part is the bigger chunk, and I plan to continue the PPF hopefully till I die and never redeem, because that is tax-free high rate of interest is not something that you're going to. I don't think there is a better product for someone like me than the PPF one.
Okay. So a question on EPF, Employee Provident Fund, that you have. You have not withdrawn that yet. Uh, so are you still getting interest on that?
I don't know. It's a very insignificant amount of money, so I haven't really bothered too much about it. So it's just less than 5 lakh rupees. So I haven't really checked, and I tried to withdraw that money at one point of time. But some UN issue happened, so पड़ा है वो किसी दिन निकाल लेंगे, because it's not a decent chunk of money, so I don't really bother with it. हाँ ठीक है.
Okay. No, the reason why I was asking this is because people would have questions. Let's say if I leave my job today and let's say I have a decent chunk in EPF, there are some articles going around that after 3 years it ceases to get interest, etc., which is not true. But then I just wanted to touch upon that. Anyway, so moving to the next question. When you selected mutual funds, right, or when you select mutual funds, what are the things that you look at, right? Why I'm asking this question, because I think you mentioned about ICICI Pro Equity and Debt Fund, right? So that has a very high expense ratio, but then performance has been really great, right? Many people look at expense ratio and they kind of decide, okay, it's though it is performing well, but the expense is very high, right? And if it ceases to perform, then I'm paying so much for this. So what are the things that you pay heed to?
Okay. See, essentially, my decision of picking a fund is typically based on what do I want to get out of it. And as long as that purpose is getting served, then comes the other optimizations, so to say.
Mhm.
So, as you can see that even if you consider these funds, they are what? Maybe 10% or 15% of my portfolio right now. The bigger chunk of it goes into pure equity funds. Now, some of those
Mhm.
equity funds that are there have been picked up with the idea of overall legacy that, okay, someone told me some fund at that point of time and then I stuck around to it. Say, for example, I have a reasonably high exposure in HDFC Top 100 Fund, which is now renamed as the HDFC Large Caps Fund. I have a pretty decent exposure in the ICICI Value Discovery Fund. Once again, I think it has been renamed as Value Fund or something like that. These are the old names that I remember because I invested in them a very, very long time ago. But beyond that, I believe over the last 5-6 years, I've primarily stuck to uh, ICICI or HDFC Nifty 50 or the Nifty Next 50 index funds as the bulk of my equity portfolio. And the international fund, say, for example, Invesco has a NASDAQ fund that is there, as well as Motilal Oswal has a S&P 500 index fund that's there in the portfolio. So all
Are
of
they
them,
still taking fresh inflows?
I don't think so. But man, I stopped earning 3 years, 5 years ago when they were. So it's not really an issue for me. I don't think they are. There are opportunities. I believe Franklin has some sort of a US opportunities fund which is still taking money, but not a problem for me because I had invested at that point of time. So these form the essentially the equity. So with all of these funds, A, the first category is the ICICI Value Discovery, HDFC Top 100 and Kotak Mid Cap, some amount here, SBI Long Term Equity. So some random stuff is there, and these funds where I have higher exposure is because I invested for a long period of time in them because someone had told them. And then the third category, when I started taking a conscious call. So I don't think I invested in these funds, as a very, very conscious call. It was more ad hoc. The conscious call has been primarily sticking to the Nifty 50 or the Nifty Next 50 funds. The other idea is that, okay, now I want international exposure. That is when those funds came as a choice. Then the idea came in that, okay, I need to do something for my asset allocation because I can't keep doing the asset allocation on a monthly or a quarterly or a half yearly basis. Let me start putting in money to let them handle the asset allocation headache for me. So whatever small little moves that they do, hopefully that should do the trick because bulk of it is there anyway. Then comes the idea of that, okay, I need to have gold in the portfolio. So that is where the gold mutual funds come into the picture. So all of them are there. So I first decide that, okay, what is it that I want to do with a particular mutual fund? First, that goal needs to be set. Now, say my goal is to, get a gold exposure. Then I look at that, okay, which gold mutual funds should I select? When I'm looking at, okay, I want to do asset allocation. So the first fund that I picked up was ICICI Balance Advantage Fund because it had a large amount of history. I looked at that, okay, is it actually moving its equity percentages over a period of time or not? ICICI comes out with a valuation index, based upon which they recommend that, okay, it's the red zone or the green zone and how you should be investing. Now, that makes sense to me as a concept that, okay, when you believe on the price to book value or the price to earnings, that the markets are expensive, that you should invest less. Is there a fund that actually replicates that? Yes, they had ICICI Balance Advantage Fund, which replicated that to a certain extent, and it's on the conservative side. It's not on the aggressive side. So I went into that ICICI Balance Advantage Fund first, built a substantial amount in ICICI Balance Advantage Fund. And then comes the call that, okay, since a substantial amount is here, which is on the conservative side of it, now let me start adding something which is on the aggressive side of it. Now, the aggressive side of it, I could have picked up probably an HDFC, also has a hybrid fund, which is on the slightly aggressive side. That's another,
Aggressive idea.
yeah. So that's another one that I looked at. But then I thought that, okay, my core idea for this fund is to balance whatever the balance advantage fund is doing. So it's better to stick to the same fund house. And that's the reason why I picked the ICICI hybrid equity fund. Because what is my goal? My goal is A, to take advantage of whatever asset allocation tricks the fund manager can play. I'm taking advantage of that on a conservative side. Now, to compensate for that, maybe there should be some the aggressive side of it as well. And if you look at it, maybe if I can just, I don't really have a quick way to check the numbers because my portfolio is split over multiple bands, me, my wife, my company. But I do believe that the ratio of balance advantage to aggressive hybrid would probably be something like 4:1. The 4 is in the balance advantage part, 1 is in the
Aggressive.
hybrid aggressive part of it. EPF, as I said, is virtually, next to negligible. So there I'm not really taking a call. So this decision of which mutual fund to pick is designed by that, okay, I want to invest in international funds. And then I look at the idea of which international fund to pick. So there I wanted to go in with the S&P 500 because it covers a much larger market. So which was available by Motilal Oswal at that point of time. Then I
So did you
wanted to
also look at China fund?
China fund, no, not really. Yeah. So what I did was I actually looked at this. HDFC has a great fund because, I thought that, okay, I have an S&P 500 fund, which is there. Then I thought that, okay, we should also, how do you get more exposure? I think by then the S&P 500 fund had shut. At that point of time, the NASDAQ fund by Invesco was open. So that is why I went to the NASDAQ Invesco fund. And then I thought that, okay, this takes care of US pretty decently. What do I do for the non-US but still a global exposure? That is when HDFC has this global world developed indexes fund or something of that sort. That's when I picked that up. So that's the reason. So at every point of time, whatever decision that I'm taking, that okay, I need to add this to the portfolio, I first figure out what serves that purpose. Then possibly the expense ratio, etc., do come into consideration.
So, a couple of questions on this in
Sure.
with the way you follow this. So, the first is you look at, hey, I need to get some international allocation. So, let's take a couple of examples here. Or I'll give three scenarios, right? Hey, I need to take some kind of exposure to US stocks. Second, I need to take some exposure to non-US stocks. And third, I want to take exposure to gold. Because suddenly today I realized, hey, gold is an asset class that is really good and it could do very well. Now, when I'm doing that, I know I have to do all these three things that I've decided. But then when I go and look at the valuation of all these three, so US did exceedingly well in the last, some time. I know that it's for long term. But then again, you kind of look at the valuation of the fund also at a given time whenever you want to take exposure to. Same goes with gold, shining very bright. Then comes China, did 40% in last 1 year. So, do you actually pay heed to any of those things, or just because मेरे को asset allocation में रखना है, so I just have to buy it now? Or do you decide, yes, I need to keep US exposure, but I'll wait when the valuation makes sense. At that time, I'm going to get more of it.
So this decision essentially is A, valuations play a role, and B, the instrument also plays a role in deciding both of these things. So let's say I do believe, even after all of this, my total in international equity, let me just check, is around 9% right now, which means it is roughly
9% of equities.
9% of total. So which means roughly 20% of equities is in 20% of equity is international exposure right now.
Okay.
I don't think 20% is an appropriate amount. I do believe that the appropriate amount would be significantly higher than this. I should not really have only 20% of equity exposure. The number has to be significantly bigger than that. But
And why
how
is
do
that?
I do that today?
No, but why it has to be higher?
Because I do believe that, I don't really have the stomach for it. An ideal portfolio would probably have 66% global, where you cover the entire globe, and only 33% as the India equity for something like FIRE for a very, very long-term period. You do not want to be over-indexed on anything. There is this great research paper which exists on this, that for the very, very long term, for people who are essentially doing the FIRE, the best possible portfolio, the ideal portfolio is essentially 100% equity portfolio in which 66% is global and 33% is Indian. And that performs brilliantly. Sorry, 33% is local. So they have done that idea from the perspective of they have looked at multiple countries, some 40 developed countries, and how they have performed for the last hundreds of years. So there is large amount of research on that, and they've done. I recommend the users to actually go through that research paper. The key conclusion that they came at was that, okay, for really long-term portfolios from which you are going to withdraw over a very, very long period of time, 100% equity portfolio works best. And in that 100% equity portfolio, 66% should be global. So that in the US, people have this option of a global index fund where you can buy actually everything on a total market weighted average. We don't have that option possible. Okay. In the US, there is possible very easily for people to buy 33% of local. So in India, we do have that option of buying the 33% local, but 66% global option does not exist. So because of those constraints, your numbers need to be different. But I do believe that by just having 20% of your equity international is not good enough. Now, why don't I have more than 20 if I believe? That is the reason. Because A, The valuations, I don't think, have been favorable post all of these bans that have come in and how you can invest in these funds. And B, there are no easy ways to invest. Now, I don't really want to take the gift city route or the vested route to actually invest in US stocks. If the mutual funds open tomorrow and the valuations became attractive, both of these things need to happen. If both of these things do happen, then yes, I would be shifting money from towards a global equity, but both of those things are not there right now.
So, but then, in the future,
Yeah.
right? Let's say, let's talk about US, right? The valuation, if that starts looking juicy,
Hmm.
you're going to acquire more of it.
Absolutely, yes.
So,
It's not
in
just the
that case,
valuation game. It's not just the valuation and a product. I'm not going to take the vested route, or I'm not going to jump through hoops to do that. I need an Indian mutual fund, or maybe the SIF products which have opened up. Maybe an SIF route should be there. Maybe a mutual fund route should be there. There has to be some route that I'm comfortable with. As of today, the routes are not really. Say I talk about the Franklin opportunities. I have the US opportunities fund, which is still open. And so A, it satisfies my mutual fund requirement. But B, the expense ratio that they have and the portfolio philosophy that they follow, both of them I'm not aligned with. Otherwise, I could have taken. So there are multiple check marks that need to take
no,
place.
both of them, you're not what?
I'm not aligned with them
You're
because
not
the
aligned.
expense ratio is too high and the way that they actively pick stocks. I would rather not do that. I would rather just pick up an S&P 500 index fund. So, which is not there. That is the reason why I'm not picking it right now. So, all of these things need to change. If they change, great. If they don't change, then what happens is when it comes the decision to sell equities at some point of time. I have sold Indian equities over the last 3 years. I have not sold a single international equity over the last 3 years. I have not sold a single unit of gold over the last 3 years. As a matter of fact, I have actually bought gold in the last 3 years to a certain extent.
So, do you think at this point,
Hmm.
China, even though it has run up by
Hmm.
40-45% in the last year, it is still lucrative? Would you want to have an exposure to China?
I have,
Because when you were
I have,
looking at,
yeah, yeah. I have absolutely no idea about China. So how China or any other country is doing at this point of time. Do I want something to get some sort of global exposure? Yes. Even if so what I would ideally like, so let's say if someone comes up, Geo BlackRock has come up with a lot of funds, and I do believe they would come up with some sort of a total global fund. If they come up with some sort of a total global fund, I would really like that. And B, in that total global fund, the valuation should be a little more reasonable vis-a-vis the Indian equity at that point of time. Both of those things need to happen. If both of those things happen, then I will put money into that. But till that happens, it's not really a decision. Yes, there might be a China fund right now. I'm not really going to take that call. Because see, once you're taking a China call, there will be periods in the next 5 years or in the next 40 years when China is going to do very well and China is going to do very poorly. Am I comfortable having China in my portfolio for the next 30 years, 40 years? No, I'm not. I See, I know Indian banking is going to do well. I have huge faith in it. But is that something that I'm willing to have for the next 40 years in my portfolio? No, I'm not. Whatever is in my portfolio, I want to have that for a 40-year period so that at any point of time, I always have the option, ki, acha, I will eat by selling this, I will eat by selling that. When I eventually die, I would want to pass on some sort of, portfolio which is essentially very similar. The numbers might be smaller, but in terms of percentage terms, I'm selling the same sort of stuff. That is why I would like to have you know, eventually I will like to have maybe just the hybrid fund, maybe just over the last 20, 25 years, 20 years of my life, I'll be very happy if I have just one fund, the ICICI Balance Advantage Fund. Everything else has been sold out
but
by
then
them.
let's say this is one of the questions that comes,
Hmm.
right? So when you have a big portfolio, for small portfolios, yes, number of funds should be low. But then when you have big corpus, at that time, do you buy other funds to mitigate fund house risk?
Not really, man. See, the sort of fund houses that we are talking about is HDFC, ICICI, SBI. sort of fund houses, Parag Parekh as well, which I have a very, very insignificant exposure in. Bulk of my money is in HDFC, ICICI, and SBI. If these fund houses go kaput, I would be worried about the head on my shoulders than
No, it
anything.
is not about going kaput. Say they have been in there
Mm.
for a long time, and they will be there for a long time. But there are some internal issues that can crop up. So when such a thing happens, and when you have such a big chunk, you are kind of stuck there. You can't take it out. You can't withdraw. You can't do all those things. So what's your take on that?
So I believe that you will anyways end up building a portfolio which will have 2 or 3 or 4 fund houses in it. So I, so I'm not saying that I've consciously built a portfolio with the idea that, okay, I should have HDFC, ICICI and SBI into it. But I don't really think that this is going to be a problem. And maybe you can have some sort of a diversification at some point of time later. But I don't really, I'll not worry about, ICICI mutual fund or HDFC mutual fund going, even this, some sort of a blockage coming in for a very long period of time. Yes, a problem might pop up for 3 months, 6 months, 1 year, but you'll have, it's again, the having the one fund, that's essentially a goal in my head by the time I'm 70, 75, because I'm just withdrawing from that and not really thinking too much about it. But I'm fairly sure that at that point of time, I'll have NPS, I'll have some annuity, I'll have some other income streams set up at that point of time. So I don't really think it will be an issue, not just for me, for anyone and everyone, because we end up having, it's very difficult to actually have a one fund portfolio. You can strive towards it, you can move towards it, and I think that should do the trick.
Yeah, eventually my goal
Mm.
is also to move towards few basic funds, right? Just hybrid ones, right? Maybe aggressive hybrid or multi-asset, and just stay there, right? So that I don't have to
And
worry
then
about
see,
asset.
another very, a significant part of the argument for me believes that you don't really know what happens in 10 years' time. You don't really know what happens in the next 20 years' time. What if my health is doing very well? What if my health is doing very poorly? I have been involved with a large number of startups over my career. I have ESOPs in some of them. I have angel investments in some of them. What if one of them works? It's highly unlikely that it happens, but what if one of them works? What if there is, some sort of brilliant returns which happen over a, 10-year, your first 10 years? It is possible. So let's say if I was lucky enough to retire in 2008, when the market was at the bottom, things would be very, very different for me. What if I have a very lucky? So you need to reevaluate these numbers, these sort of thought processes over a long period of time. The fundamentals need to be in place. And I do have a, document written with some sort of a philosophy that, okay, at all points of time, you need to be diversified across X, Y, Z sort of assets. At all points of time, you need to have at least this much in debt, at least this much in equity. I've put in those sort of ranges to that. And I do believe that works as a guiding light. And I have written that, okay, I'm not really going to change that at least a 5-year period which comes in. So, for example, I am right now very much in favor of something like 100% equity portfolio based upon whatever research I've read, but I don't really have the mental capacity to handle a 100% equity portfolio. I cannot do that. I cannot live with, I cannot survive the mental gymnastics that I'll have to put myself through for the extreme amount of variations that it is going to have. So I cannot do that. But, that does give me a direction that, okay, that is the direction that I should be working towards. Now, if that is the broad direction that I should be working towards, do I move away from the hybrid funds? No, because they serve a bigger goal. Do I move away from the debt part of it? Yes. So I will reduce my debt portion over a long period of time. And, essentially the debt portion was there to take care of the sequence of return risk for the initial 5, 7 years. I have been 3 years into the game. The first 3 years, okay, the first 2 years were phenomenal. The third year has been average. I still haven't had a
Yeah.
bad
Yeah,
year.
on that I have a question. So what has been your portfolio return for the last 1 year? Market has done nothing
So my portfolio return has been, I saw it today morning, it has been 3.8
for last 1 year.
for the last 1 year. Yes.
Okay. And you also brought up another important point, that you have some guiding principles that you develop and you keep writing it and then you follow that. But as humans are, we kind of keep evolving. Similarly, those ideas keep changing.
Yeah. So 5 years is when I will sit down and reevaluate that. So I have made a model for myself that, twice a year I will look at my portfolio around Holi and Diwali. And that is when I'll take any call that needs to be taken if there are any changes, significant changes. Say, for example, right now, if suppose the mutual funds were US mutual, suppose gold was doing very, very poorly right now, then maybe I would have picked up some gold. If, so say around 2 years ago is when I started picking up gold. Around 4 years ago is when I started investing in sovereign gold bonds. But then 2 years ago, sovereign gold bonds were virtually vanished from the market. That is when I started picking up a gold mutual fund. A product existed at that point of time.
So why not gold ETF? Why gold mutual fund?
Because gold ETF is too much work. For a gold ETF to work, you will need to, have a demat account, go there, buy there. You cannot really do that systematically. In a gold mutual fund, what you can do is you can put your money in. So this is exactly what I did. I put money in HDFC liquid fund. I started a flex STP into a gold mutual fund. Now, what a flex STP does is, so instead of transferring 10,000 rupees daily, what it will do is, depending upon how much you have in the portfolio and how much it is doing, on some days it will invest 12,000 if gold has fallen. It'll invest 15,000. It has the option to invest in higher amount if the algorithm is favorable, and it can buy daily. I cannot execute both of these factors for that. And for that, essentially, otherwise I'll not be able to buy. See, my prior experience tells me, because SGBs were essentially a product which were traded on the market and I couldn't really buy them very, very easily, because I had to take a call that, okay, money should be there in my account. Then I transfer it to Zerodha. Then I buy it on a particular date and at a particular price point. I have to look at how much premium or discount is available. All of that analysis added a barrier to my actually investing in gold. So if I could do that, probably, but I have data and evidence that I wasn't really able to. So I still got some SGBs. It's not that I don't have SGBs. I was able to get SGBs because whenever they got issued. So I moved on to the idea that, okay, I'm not able to buy from the secondary market. Every time it gets issues, I will buy 50 grams or I will buy 100 grams. So that's how I actually accumulated some SGBs. I wasn't able to buy from the secondary market with discipline. But once that option of issuance is gone, how do I buy it now? And that is where the mutual fund made the process a lot more smoother. And that is essentially why I am able to have a 6% gold in my portfolio. If I hadn't done that, I would probably be sitting at around 2% or 3% of gold in my portfolio.
Okay, so at what point would you think that you need to shrink your gold portfolio?
So my gold portfolio should always be between 5 to 20% is the sort of range that I have for gold in the investment policy document that I was telling you about, which I'll revise every 5 years. So as long as it remains in the 5 to 20% range, I don't really bother uh, too much about it. If it
Okay, so
goes
it is
above,
not, but it is not based on how quickly gold has risen.
not really.
Later.
So A, it's the 5 to 20% range. B is if I need the money. So if I need the money and there is no money in debt which is available, at that point of time, I'm going to look at, so let's assume a scenario that there is no debt in the portfolio. If I have debt in the portfolio, debt gets sold first.
Basically,
Don't
gold
have
will
debt.
never be sold, regardless of
Gold
how.
will be, so gold will be sold. That suppose we are in a market. So let's say the market of today. If we have the market of today, I have Indian equity. I have gold in my portfolio, and gold is, suppose, 6% of my portfolio is in gold. I would happily sell 1% of the gold in my portfolio if I did not have debt. I would rather sell gold right now rather than selling Indian equity, because at all points of time you are deciding, okay, what to sell to feed. I have to eat now, boss. So you have to sell something. So today, my priority order is sell debt, sell gold, sell international equity, and then sell Indian equity. This will be my priority order if I was selling today. But I don't have to take that decision for gold right now. But there is a possibility in future, and I hope that I'm able to get to that where I am in a situation where I have gold, Indian equity, and global equity in the portfolio, and then maybe selling gold makes sense.
Let's take an example. Today you get 10 lakh rupees from somewhere and you have to invest that.
Hmm.
Would you park all of it in equity, all of it in gold, or debt? I'm not going to. Would you park all of it in equity or all of it in debt, or would you divide it, maybe 70
I,
30?
I, I, I would just park it in whatever random person tells me, "Acha, हाँ, हाँ, ले ले," because 10 lakh is essentially less than 1% of my entire portfolio. So I don't really take decisions based upon, whether based upon the amounts. When it comes to spending, there also I like to take decisions based upon percentages. When it comes to investing, also I like to take, a percentage based decision. So if you talk to me right now that, okay, I'm giving you 10 lakh rupees, where are you going to put it in? What are the options? Debt is an option, gold is an option, Indian equity is an option, global equity is an option. There is no easy way to invest in global equity right now. So that is out of consideration. So we are left with debt, Indian equity, and gold as the choices. And all three of them are fairly easy to invest. I believe I'm going to put this money in the ICICI equity and debt hybrid
Debt.
fund. Boss, you take the money. I don't want to take the headache of asset allocation. I know that I'm not going to go in gold because that's very high right now. I know I'm not going to go in international equity because that option is not there. It has to be a call between debt and gold right now. I don't want to make that decision. I will put it in ICICI equity and hybrid fund. And I believe I so until and unless the amount is 5% of the portfolio, I'm not going to give it a very serious thought. And if it is 5% of the portfolio, I still think my decision is going to be ICICI equity and debt fund is exactly where I'm going to put in the money today.
And if gold would have not risen so much, then
Hmm.
also your decision would have been same.
No, if gold hadn't risen so much over the last, 4 years that I have been investing. So I think I started investing in gold in maybe 2020, 21, and I invested till 2024, 2024 March, 31st March 2024 is when I last invested in gold. That's when my STP ended because I remember it very distinctly for that financial year. So post that, I stopped the STP purely because I think the valuations are fairly crazy right now. And the other part is that okay, I was visible that okay, it is now in my that 5 to 20% range. So that range was the guiding factor.
So why would you not choose ICICI multi-asset fund
I don't
rather
want too
than
many funds in my portfolio. If I had ICICI multi-asset fund in my portfolio, I would probably had a serious look at that. But because I don't really have ICICI, I have the only multi-asset or hybrid funds that I have in my portfolio are these two. I don't want to add another one just because okay, that might give me some sort of a gold or a silver exposure. I'm not going to add to my troubles for that.
but if you were starting afresh, would you have looked at that?
If I was starting afresh,
Like
if I
these
was, if
hybrid
I,
funds won't have been
yeah,
there
yeah. So
with
if
you.
I was starting afresh, then I would probably be going in all in equity right now because then my decision is, okay, I want to make a large amount of money over a long period of time. So then I would not really be going in for a multi-asset or I would just give, okay, fine, whatever money I have, just keep buying, keep putting money into equity. Don't think too much about it. Whatever equity you get, just keep buying, keep buying Nifty 50 index fund. End of story. Don't think too much about it if I'm starting my career.
What is your take on this scenario wherein, let's say, there is a 30-year-old
Mhm.
who has invested for a long period of time, he has certain amount of equity exposure, but is poor with asset allocation, right? मुझे नहीं समझ आता when do I do asset allocation, when I do this I have to pay taxes, etc., etc., and he wants to get rid of this headache. What if that person decides to put in all of his money for next 20 years, 30 years through a multi asset allocation? Is like मेरे को नहीं करना है ये. I'm not going to do this asset allocation myself. I'm not going to pay tax each time I'm going to move this. Let the fund manager do it, right? And gradually I'm going to move all of my equities also into this.
Fair. I would not think that is a good idea, because as a 30-year-old who is essentially going to work for a long period of time, the biggest money lever that you have is the money that you are going to make over a long period of time. And in that, saving taxes becomes very, very important. So my first thing that I will like to tell this guy is that, okay, you maximize your PPF. You maximize your wife's PPF. If you have a daughter, you maximize your Sukanya Samriddhi scheme. These schemes, a lot of these, you maximize the amount that you can put to the NPS part of it. So that is what I would tell him first. And once all of that is done, what has happened is that you have built a debt exposure. Because however much you try, PPF, Sukanya Samriddhi scheme, the EPF part of it, whatever government scheme that you can avail of, they are very, very debt heavy and debt centric. Even the NPS part of it, they are moving towards the 100% equity regime fairly soon. But as of now, 25% should be in debt. So your debt portion gets taken care by that. Anything over and above that, you are essentially saving for the long term. So I'm not really talking about your emergency fund or your house buying or anything like that. Over and above that, whatever you are saving for your retirement, that should go 100% into equity. I would not really recommend a multi-asset, because you have a compulsory debt allocation which has already taken place. Now, if you are essentially making the argument about someone, who doesn't have any debt allocation, then I think that is a problem. You first need to get products like PPF in the picture first. You first need to get products like NPS in the picture first, because those are government grants which are being given to you, in my opinion, which you should be maximizing from a 20-year, 30-year perspective. See, your retirement is essentially a 30-year decision. And so you start putting in this money, you will initially have very little money. So if you do EPF maxing, PPF maxing, PPF of your wife, Sukanya Samriddhi Yojana, and all of that at the age of 30, NPS maxing at the age of 30, you will not have too much left for equity. You will anyway start with a heavy debt allocation and some portion in equity. It'll keep on growing. It'll keep on, and you keep putting money in equity, you keep doing all of this. At some point of time, equity will overtake your debt part. At some point of time, your equity would become so much that your debt part will start to look insignificant enough of it. That is perhaps when you start thinking about, some sort of an asset allocation. So that is when your multi-asset funds or all of this starts coming into the asset allocation is not a decision for you to take. Taxation is the decision for you to take. You take that taxation-based decision, get that done with, which is where the PPF, EPF, NPS, and all of these come into the picture. Post that, just go 100% equity. I will not recommend multi-asset for that guy.
So let's say, basically, you're saying max out your PPF. So let's say somebody who started
Max out your
earning as
government schemes. PPF, EPF, SSY, NPS. These are all tax-saving government schemes that you should maximize on.
But PPF is going to give you 7.1%
Yes.
interest. I know it is tax free, right? EEE. But then again, I'm talking about somebody who is, let's say, I don't know, 25, 30, who has who is able to invest 4-5 lakhs in a year. And if they are parking 1.5 in PPF, right? Plus, if they are working, right, in a corporate, so they would already be investing some part of it in EPF also, Employee Provident Fund.
Yes.
Would it make sense to that person to park that money in equities rather than invest?
Not really. So you have to look at this decision as not a 1-year decision or a 2-year decision. So if you are 25, you are essentially looking at it as a 35-year decision. So the limit for the PPF part, which is the 1.5 lakh part, that and the EPF and the NPS. So in your initial years, it is possible that you're out of that 4 lakh or 5 lakh of your investable surplus that you have, it is very much possible 80% is going into these schemes and you have only 20% left for equity. These schemes will get capped fairly soon. 10 years down the line, when you are 35, if you are saving 4 lakh rupees at 25, at 35, you will essentially be saving a lot more than that. Your career, you will not be saving 8 lakh rupees, you will be saving perhaps 25 lakh rupees at 35 if you are saving 4 lakh at 25. Even then, your PPF part and your debt part is going to be just 1.5 lakh rupees. That doesn't really grow in terms of the amount you are allowed to invest. So your equity investments might be lesser initially, but over a 35-year period, those portions will go really, really high. And the advantage of this tax-free money, that will be very, very evident. If you look at your next 35 years, you cannot make the decision based upon what to do right now with this to, you have to look at it from 35-year perspective. Would you not want a substantial chunk of, or 1.5 lakh rupees on average for the next 35 years growing at 7.1% tax free? I would want that. Because eventually, I do not have the option to go back and invest in PPF in 10 years before. In equity, I can keep on adding more and more and more, and then take an asset allocation call, maybe 5 years, 10 years, 15 years. At some point of time, it would become necessary to take an asset allocation call because your equity portfolio will be so much that A, it is very high in percentage, or B, you are not able to handle that, which is what will probably happen with the substantial number of people. Okay, all my portfolio goes down by 7 lakhs in 1 day or 2 days. I am not okay with that. So that
But
meant.
there is another line of theory, let's say.
Mhm.
I understand what you're saying, that because there'll be limitations, there is going to be a capping. You won't be able to invest more later. Let's say for even 5-7 years, I keep investing 1.5 there,
Hmm.
right? Essentially, let's take an example of 3 lakhs, right? Just for the viewers to understand or get the perspective. So basically, I'm investing 50% of it in my PPF. Some percentage is already going in PF. Why not invest that in equities? Because for 5 years, that is going to give me better returns. I
See,
know,
that,
even with
yeah,
tax.
see, that's what I'm saying. That, you are, see, you are essentially making an assumption based upon the fact that for those 5-year period, or see, I'm anyway saying that this ratio is going to get skewed fairly soon. This ratio, if you are saving 4 lakh rupees at 25, within the next 5 years, you will be saving more than 8 lakh rupees. People's savings do double, or rather more than double, over that period of time. Either you are not saving 4 lakh rupees right now as a 25-year-old, but the impact of, so your equity part will keep on growing. This tax-free interest, this tax-free rate of 7% return that you are getting is phenomenal. And this will compound over time, because whatever you have put in the first year and the second year and the third year, that will swell over your debt portfolio, so that by the time you are 50, whatever is your PPF corpus, that will generate such a high amount of tax-free returns, whereas your equity part, anyways you would have compensated for that equity part in future. So the equity part will also keep on growing. So in the first year, you are able to put 50,000 rupees in equity. In the very second year, you will be able to put 70,000. In the fourth year, you will be able to put 2 lakh rupees in equity. By the time the 10th year comes, you will be putting in 15 lakh rupees into equity. But that is going to just remain 1.5 lakh. If you do not put in heavily into that in the first part, eventually, by the time you are 50 or by the time you are 40 or 45, whenever you are deciding to pull the plug, the amount of money that you will have in your PPF, if you do not do these 1.5 lakh things, will become so insignificant. Say very similarly what has happened with me for EPF. Because I was not in a job, my EPF corpus is very insignificant. It doesn't get me anything. It serves no purpose. It's just that okay, I was in a job and I did it. But, you don't want your PPF to become something like that. You do not want your NPS to become something like that. That's just there. They are fundamental levers of long-term money generation in a extremely tax efficient manner. So maybe for the first 5 years, I understand, maybe for the first 5 years, 7 years, it does not sound like a very, very optimal decision, because probability wise, equity is going to give you more. But you are going to have PPF as a product for the next 40 years. So if you are looking at PPF as a product that you are going to have for the next 40 years, think about it that way. Maybe the first 5 years it is suboptimal, but later you have no option to put more money into that product. Equity always gives you an option to keep on increasing as much as you want. See, think about it this way. Eventually, there will come a point of time in your life where you will need some sort of debt exposure. And for debt, you will buy some sort of a debt fund, for example. PPF is going to be phenomenally better than debt fund as a debt allocation for your portfolio. It's government backed, tax-free, interest and everything. But you will not be able to buy that at that point of time. Say, for example, right now, both of us can sit and argue that SGB was a brilliant product, but can we buy SGB right now? Well, secondary market is there and there are its own complications, but we can't really invest in SGB because that product is no longer available for us easily right now. I don't want that to happen to a 25-year-old with a PPF when he realizes when he's 35, 40, yeah, if I will have I will have a debt mutual fund for 30 years. So the lesser amount I have in debt mutual fund, the more I have in PPF is a better idea that provides stability to my portfolio. So no, I will not recommend that for the first 5-7 years of comfort that, okay, in first 5-7 years, it's going to grow. I'm not going to do that.
Let's say for a working professional, why even PPF, right? Go for EPF because
Yes.
that is going to always give you 1% more return.
Yeah.
And if you're going to max out, you'll have nothing to actually invest,
Correct.
right?
So
That-
that's the initial part of it. So for in the initial parts of your career, you should be maximizing your EPF. You should be
so I
maximizing
think that
F.
you can
And
invest till 88% of your salary or basic. I don't know. It's something
no,
like
no,
that,
no,
right?
no, no, no. Okay, yeah. So you don't. So you invest only till you get the tax benefit out of it. So that's my maxing part. So in NPS, you get the benefit only till the 10% of
14%.
pay, 14% of basic pay. So
Yeah, new
that
regime.
is the part that you invest in NPS. Very similarly, EPF also, I believe, has some sort of restriction till which you get a tax-free interest.
Oh, like, okay. So that's what you meant. All right.
Yeah. So
Okay. Okay.
by maxing out, I mean you max out in all of these products till you get a tax benefit. Whatever is over and above that, that is where,
Sorry, I totally misunderstood. That's why I was kind of quizzing
no, but
myself,
see,
right?
so let's say you get in PP. So again, for EPF, it's the tax capping. For NPS, tier one, you are only allowed a particular amount. So
14%.
in tier two, it is zero. For
Yeah.
EPF, whatever is the tax mapping. For PPF, the max limit is 1.5 lakh rupees. So there
But
are
again,
separate
the
limits
tax,
for all these products.
the
So
same logic, right? 1.5 lakhs is the limit there, and 1.5 lakhs is the tax-free limit. So,
I'm not sure what the EPF limit is. I somehow remember 2.5 lakh is beyond which your interest becomes taxable or something like that. I don't know.
no.
Anyway, the fundamental idea is that as long as you are getting tax-free interest, that's the idea.
Okay.
So
Okay. So,
as long as you're getting tax-free interest, whatever is the max. So on SSY, Sukanya Samriddhi Yojana, you get tax-free interest, maximize that. PPF, you get tax-free interest, maximize that. EPF, you get tax-free interest, maximize that. NPS reduces your tax liability, maximize that. Whatever is that 10% or I think 14%, whatever the limit. 14% isn't that for government folks and 10% for private?
no, recently a change happened. So, for folks in new regime, if their corporate allows, then you can invest till 14%.
Brilliant. So 14% is what you do there. After that, you are in the initial years, you're not going to be left with anything, but that's okay. It's a 35, 40-year investment product that you are talking about. So
Okay.
perfectly.
And do you take active calls based on market situations, or you just don't care? You invested for 5 years, 10 years, etc.
So I do take active calls. Depends on what you define as active calls. For me, an active call is
So,
essentially every 6 months or so, whenever I feel like it, I sit down and do a portfolio review and decide if I need to move some money from somewhere. I do take active calls based upon that. Okay, if there is an expense which is upcoming, I have to pay a credit card bill. What exactly should I redeem from where? Which fund should I take my money out from? Those sort
okay,
of
yes.
calls.
So that brings me to the next question. So whenever you're planning to withdraw, the way you planned your investments, how did you plan the tax aspect of it?
I can't do anything, boss. Whatever tax liability comes in, it comes in, but it's not really in my control.
I'm sure you must be looking at it. So if I'm going to withdraw from, let's say, at least 1.25 lakhs, let me withdraw from equity so that at
Yeah,
least I'll
yeah, I
save
do that.
that
So
much or
yeah,
something.
whenever I am making these sort of decisions, I do take care of that 1.25. So that's why I have three accounts that I keep my money in. It's my account, my wife's account, and I have a private limited company as well. So that's where I keep my money, and I do take these sort of optimization decisions
Yeah, so
because
7.5 lakhs of tax-free money at
whatever. So
least.
my tax liability is, fairly virtually insignificant amount of tax liability comes in because it's so well distributed across asset classes and I do claim from it. So it's not really, it hasn't really been too much of a bother except in the year 23, 24. In that particular year, I or maybe it was September 24. I forgot when it actually happened. But at one point of time, I decided to, just pull the plug on all the regular funds that I had, which I had purchased over a long period of time. So I decided to pull the plug. Okay, markets are doing well. Take all the money out from all the regular funds that I had. And I had a large number of funds. The amount wasn't really that big, but in terms of the percentage of the portfolio, but that did cause some sort of tax liability. But again, that was a fundamental choice and a question. Okay, fine. I don't really want so many funds in my portfolio. I don't really believe in the idea of active funds. And how long am I going to keep track of that? So, just chucked all out of them. So that point of time, there was a tax liability. But other than that, with the amount of expenses that I have, if you distribute it over two people, the capital gains that we have, the tax liability is not really an issue.
Okay, so you talked about withdrawing these regular mutual funds.
Yes.
Yeah. So did you liquidate them uh, to fund your expenses,
Yes.
or you just okay to fund your expenses?
Yes.
Because you said you did that when the markets were high. Ideally, the best time would be to
Yeah.
do it when the markets are tanking, right?
So
You
I
believe that?
actually, essentially my belief, I think it was last year, the equity portion of my portfolio was getting to 67, 60 sort of percentage points, which was something that I was not really comfortable with. So I took a call on, okay, maybe 67, 68% is too high. I need to reduce that. So to reduce it by a few percentage points, I sold that out. Whatever money that I got from it, it was spent on a couple of international vacations that I went on. So yeah, now I remember it was last year. So a couple of international vacations that I went on. So some money went to that. The rest of the money that was left, that went into ICICI equity and hybrid fund, because that is when I started it. So yeah, so this is exactly what happened. Till then, I only had that balanced advantage fund. And that's when I thought that, okay, fine, now I'm taking out money from equity. I want it to reduce a little bit. I can spend or essentially save money on debt, or B, I can put it somewhere. I could have put it in equity. I could have put it in a balance advantage fund, but I decided to put in that, okay, let me take the aggressive call with this particular part. I put that in an equity and hybrid fund at that point of time.
And what is your desired asset allocation? 60/40, 65/35?
Equity, debt, and gold. These are the three categories that I'm talking about. In equity, it is 60 to 70% is what I prefer. And
Okay.
the boundaries that I have for that is 50 to 80. So preference is there, and then there is a hard range that I have. That whatever happens,
Mhm.
it should not go out of this hard range. Preference is 60 to 70.
So when the hard range, it is breached, you take immediate action,
Yes.
right? You don't wait for that time period, etc.
Yes.
And so when the preferred range is between 60 to 70, so even if it goes to 75, you're not going to do anything. You'll wait for that period, 6 months, or like Holy
I'll take
Diwali
a
you
call. I'll
mentioned.
take a judgment call. So as long as it is between 60 to 70, I will,
Mhm.
decide based on my own. The idea is essentially, there is a certain asset allocation where I have hard ranges and preferred ranges. Say for equity, the
Mhm.
preferred range is 60% to 70% is my preferred range. And the
Mhm.
hard range is 50% to 80%. So as long as it is between 60 to 70%, I will take a decision based upon what my gut. Do I believe markets are too much, or do I believe the markets are attractive? I will buy or sell. It is completely on my own feelings, so to say. If it is outside the preferred range, but inside the hard range, that is कि ये 50 to 80, मतलब 60 के नीचे चला गया है और 50 के नीचे नहीं गया है. In that case, I will take an action such that over the next 6 months, it gets into the preferred range. So I'll start some sort of an STP, so to say. On the other hand, if it has broken the hard range, then I will take the action on one day and I will move 10% money from one asset to,
Regardless of taxation, etc., etc.,
irrespective
whatever.
of anything, that if it has, because that is a very, very extreme scenario that from your preferred range, it has gone to exit the hard range in 6 months.
And you did nothing while it
And you
was
did
going up.
nothing. So
Yes.
if all of that things have conspired that way, then yes, I need to take a very strict action. But I till date, I haven't had to take any action, and I have remained in the preferred range. Say, for example, for gold, I wasn't in the preferred range after in 2022 in the SGP. So even though I believe that, okay, gold is too high or something like that, I still kept buying till I got into the preferred. It is still at the bottom part of the preferred range of 5 to 10%, but at least it's in the preferred range, and I'm happy that it is there now.
Okay, so that kind of explains. In your asset allocation, it is 5 or 6%, right?
It is
Gold.
6% right now. It is in the preferred range of 5 to 10%. Before
Yes,
it was
but then you're not taking any call because it is in that preferred range
the
and
preferred
gold
range.
is soaring right now.
Yeah.
Okay, makes sense. That covers almost all of my questions. I had some, but I think you already answered those in the previous video. Uh, so thanks a lot for joining and
Happy to be here, man. Happy to be here. And in case any viewers have any follow-up questions, please comment on the video. I'll try my best to answer those comments to the best of my ability. You can also reach out to me on Twitter or LinkedIn, and I'm always happy to talk to people if I can probably push them in the direction of fire. That is something that I work towards very hard on. Thank you.
I really appreciate it. Thank you. Thanks. Bye bye. Have a great day.